I'm cautious about the future of real estate as an investment. And if you think about the returns and the risk, I think we are not yet back in a place where it makes sense to just pour money generally into real estate.
Why do you think you're one of the 12 that stayed?
I've been asked that question before, and I think one of the reasons I was kept around was it was actually the first time in my life that I had to get up in front of a group of people and explain what I was doing with their money. Real estate as an asset class has, in some respects, categorically failed to deliver the promised returns. I was petrified that no matter how hard I worked, I would still just be pushing water uphill. And as soon as my grip loosened, the water would just come rushing downhill again. I was petrified of losing my job.
Jon, welcome to the People Property Place podcast.
Thank you for having me. It's great to be here.
No, not at all. Well, it's a real honor, genuine, real honor that you're here. Your name has come up time and time again as someone that I must get on the show. So it's awesome that diaries have aligned and you're in London and you've got availability to slot me in. So thank you.
The stars have lined up and here we are.
So
my kids don't think I'm real, but when I told them that I was going on a podcast, all of a sudden they think like, oh, dad's joined the 21st century. So here we are.
Nice. Well, look, it'll be interesting to see their feedback on it. So you've had literally an unreal career. Some of the badges that you've picked up in terms of your corporate experience from Morgan Stanley, Merrill Lynch, Tishman, Goldman, Blackstone. Some people would dream of just having one of theirs on their CV. You've kind of collected them all, and you've gone on and set up your own business, Realty, which we will come on to a little bit later in our conversation. But before we kind of get there, can you just rewind the clock and just tell me a little bit about your kind of origin and how you got into real estate in the first place?
Sure. And I was born in Baltimore. I don't actually admit that to many people. That makes me a Baltimorean, and I absolutely love the city, but I only lived there as a child. And I didn't really know very much about real estate, but through a very strange set of coincidences, my grandfather, who was an accountant, owned a building. A client couldn't pay him, so the client offered the building instead. And then when my grandfather passed away, and this is a very, very small office building in what is not the CBD of Baltimore. And my grandfather, when he passed away, the building sort of came down in my direction, and this building was supposed to help me pay for a university. And I had to figure out, how do I actually take a building and turn it into cash? And I learned the hard way. I've had to figure out how to lease it. I had to figure out what is property tax? What is this? What is that? And I didn't really have anyone to guide me. But I sort of worked it out, and I thought, actually, once you got past the crisis thinking, what am I going to do? This is all not going to happen. This is all going to fail. Once you get yourself past the crisis thinking and break it into the little steps, I have to figure out, how do I get a tenant? Okay, to get a tenant, I need a broker. But, how do I get a broker? Do I open, it was at the time, the Yellow Pages, the phone book. So I had to sort of figure out all of these things, and eventually the building sort of came to life, and I sold it and paid for university. So that's what I tell people. I had to work for it, but I also at the same time got a free ride.
And how old were you at that time? 17, 18?
I was 18.
You were 18. And you wanted to go to university to study what and to do what?
I wanted to be a mathematician, and I wound up studying economics. And sort of married the two because at the time, this is the mid-90s, game theory was emerging from some confluence of mathematics, psychology, statistics, economics, behavioral science into its own field. And I studied under Farouk Gul, who at the time and still is one of the preeminent thinkers in game theory. So game theory is about, it's using mathematics to explain behavior. And oftentimes people make very poor decisions, or what looks like poor in hindsight, but was the right decision at the time. And it's the study of, why do people do the things they do with very limited information. And why does everyone not always do the same thing? And why can I not predict what this person or that person will do, but I can, if I have a large data set, I can predict what I can make very, very good and accurate predictions over large pools of people, large populations. And all of this was sort of coming together at the time. And the internet was starting to become a real thing, and data was being more accessible in spreadsheet format. So this was all sort of coming together. And I studied applied and computational mathematics, and I thought I was going to be a mathematician.
And what, teach maths or be an actuary or work just in industry?
I couldn't see more than one semester ahead of me. But I got very, very lucky. I got a summer internship at Merrill Lynch in something called private equity. And at the time, I didn't know what that was, and nobody knew what it was. All of my friends were getting internships in consulting or investment banking. And when they said, well, what is private equity? And I didn't really know, because I got the internship and it was still 4 months away. And when I went to Merrill Lynch, I worked on the fundraising for Colony Capital's, I think their first continuation fund. So Colony was founded in 1991, and this is 1996. So it was, I guess, 5 years after they had done their first fund, and they had started to build a track record. I started to learn about things. What is an IRR and what is a PPM? And this whole new language emerged. And in school, I'd studied stocks and bonds and correlations and asset pricing like any good economist stroke mathematician at Princeton would. But this new asset class, and it was at the time a new asset class, was a complete mystery to me, and it opened my eyes. But I couldn't explain it, and nobody knew what it was. I said private equity. I said, what's private? Like a private club? Or nobody knew what it was. And my first summer, I went to the Private Equity Summit, which doesn't exist anymore, in Washington, D.C., that was sponsored by Merrill Lynch. And John Brown, who was at the time the chief executive of BP, came and spoke, and he was very involved in the running of the BP pension fund. And the BP pension fund had just made its first major allocation into private equity, along with the pension fund of Ford Motor Company. So all of the private pension funds from the big, let's say, US and global corporates were starting to pile in, because this is the mid-90s. The stock market was what people thought was at a cyclical peak. Of course, it's 10x what it was back then. People were worried about the bond market, the US taking on too much debt. By the way, that was at a time where the US was running government surpluses. And here comes this new asset class, uncorrelated to the equity market, uncorrelated to the bond market, that could provide long-term stable returns to pension funds and insurance companies and financial institutions. And it was very interesting for me as at the time, a 20-year-old, to be in the room when these large household names were making their first investments into what are now household name pension funds, making investments into household name funds like Blackstone. And at the time, this was very, very fringe. And I remember my time there was limited, because at the end of the conference, at the end of the day, there was a cocktail reception, but I was not allowed to go because I was only 20 years old and not of legal drinking age.
Not 21.
So
You had to go.
So I had to leave. But that was my introduction into the industry. And for a long time, I think we were seen as sort of the kind of like the second tier citizens in financial services, where the real prestige and money and adrenaline was really in investment banking, and private equity was very much of a backwater.
So for you, did you like the fact it was slightly opaque and it was emerging, and real estate was not necessarily institutional grade at that side, and you thought you could combine your mathematical expertise and capability to drive superior returns, and you felt that you had an edge within that space rather than playing in the kind of more investment banking Wall Street game?
I didn't find I didn't at the time know what the potential was. And I really don't think anyone did. And one of the reasons why is the private equity, especially in real estate, got started in the United States in the 90s after the savings and loan crisis, which for the education of your listeners was the US at the time had a large number of small banks who all made loans on very low interest rates. But as interest rates grew and the amount that these banks had to pay to their depositors grew, they got to a place where the amount of money that they had to pay out to savers was far in excess of the amount of money that they were taking in interest on loans. And this was pervasive across the entire industry. So a large number of banks went bankrupt and fell into the hands of the federal government, which effectively nationalized them and sold off their assets. And the pioneers of private equity at the time were people who looked at these terrific assets and thought, well, this is a great building with a great future, great potential, great location, great tenants, but a lousy capital structure and an ownership that is illiquid with no future. So if we can buy these assets super cheap and we can bring them into a fund structure where their liquidity is preserved, we can manage them, we can grow them, we can invest in them, and then ultimately we can sell them to whoever the right long-term owner is, be it a pension fund or an insurance company. The REITs were just getting going at the time. Green Street just started its research around this time. So this was all in the mid-90s. This was all happening, and it was super exciting.
So talk to me about your first actual job, because that was at Morgan Stanley, right?
I was at Morgan Stanley for close to 5 years. And I was an analyst, and I worked on some pretty interesting deals. I didn't know it at the time. The thing is, you're staffed on something and you see what is in front of you at the moment. I have to build a model. I have to make a presentation. I have to research this. I have to organize that. And you don't actually realize at the time how exciting it was. For example, I worked on one of the first non-traditional REIT IPOs of a timber company. I worked on the IPO of Burberry, which was it was at the time owned by Argos. It was a conglomerate called Great Universal Stores, and they decided to IPO Burberry and then do a sale leaseback of some of the real estate. So I was involved in that, and I didn't actually realize how landmark some of these transactions would actually become over time and would be seen as reference points. But it was all, for me, about experience building.
You were with Morgan Stanley for 5 years or so, leaving as an associate. And if I'm not mistaken, you went on to Tishman. Why did you make that jump? And I think at the same time you did an MBA as well.
That's right. So I moved to Tishman Speyer. I had a good friend from university who worked there. And I thought, well, actually, like what I'm doing here at Morgan Stanley is wonderful, but it is ultimately financial engineering. And I won't think of myself as a proper property person unless I actually get involved in development. I thought, well, if I'm going to do development, I might as well try to figure out like who is the best at development. So I thought, well, that's New York City. And Tishman Speyer at the time owned and still it does own with the Crown family, Rockefeller Center. At the time they had just bought 200 Park Avenue, the MetLife building, formerly the Pan Am building. They own the Lipstick building. And they were, Jerry Speyer was basically the king of New York real estate. And it just so happened that I knew someone who worked for him, who was a mate of mine from university. So I called him and I said, would they take someone from a bank? And he asked around. He said, absolutely. Actually, they're starting a debt financing team. So it was very strange. At Morgan Stanley, I was a real estate person, but when I went to Tishman Speyer, they all just saw me as a banker.
He just saw you as a debt
for the first few months, and I was organizing. Tishman was doing a landmark redevelopment in Washington D.C., and I helped organize the financing for that. And then as I was working on the financings, I learned more about how development management agreements work. And I got to go on site and slowly just sort of absorbed all of this super interesting stuff that was happening in, at Tishman at the time, and still is a marquee developer of landmark office properties in global gateway cities. And what an amazing place it was to learn.
And so at this stage in your career, had you got a view in terms of the direction on where you wanted to go, or were you just busy just stacking various different skills, being really, really curious and just expanding your network as well?
There was no, I'd love to say there was a plan. I'd love to say there was like a 5-year plan and I had like a secret checklist. That never really happened. I think what I was more focused on was where's the opportunity, what is interesting, and what motivates me to get out of bed in the morning and do a good job and work hard for my bosses.
You were with Tishman for 3 years or so before you moved to Goldman Sachs. How did that come around?
So again, my college roommate called me and he worked at Goldman at the time, and he worked at Goldman since university. So that's all the only world he had ever known. And he called and he said they're looking to hire someone in asset management in London. And I said, I'm not going back to a bank. And he said, no, it's different. Just do me a favor. They're putting me under pressure to find someone. Just go meet them. And he said, and also it's a very small team. In fact, you'll be the first hire. They've never hired anyone into asset management in London before. All the asset management people previously sat in Archon in the original Goldman office in Paris. So you'd be the first hire. So you'd be, they'd be well treated. And I went and met Pat Tribolette, who was my boss for a number of years and mentor. And he was and is probably the nicest, most thoughtful, calm, rational investor I have ever come across. And when I met him, I spent about an hour with him. I thought, this is the kind of person I want to work for and learn from.
And your role, was that asset management orientated, or was it working in the kind of the asset management arm as origination, execution, asset management, and dispositions as well?
It was purely asset management.
Asset management.
The way Goldman worked at the time, and most groups did, is they had an acquisitions team. The acquisitions team would buy something, and then they would throw the file across to the other side of the cubicle, and it would land in the asset management team, and the asset management team was responsible from the moment it closed until the moment it was sold. But it was a huge learning experience because Goldman at the time was probably one of the largest between Whitehall, which was the Goldman real estate brand, and Morgan Stanley's Mesref brand. And maybe with the third LebRep, Lehman Brothers, were probably the 3 biggest private equity investors in Europe in real estate, far bigger than Blackstone, Starwood, and the ones we think of Brookfield, the ones we think of today as the preeminent ones. It was really the banks. So there I was managing assets all over Europe in all kinds of asset classes, all kinds of geographies at one of the largest investors in Europe. So what better way to learn the business?
You joined in June 2007. So you must have seen an awful lot of good, bad, and ugly during that period.
Yes, I would say it was 6 months of up, followed by 3 years of down, and then 2 years of storms, where there was the team reduced substantially in size during that period of time. The equity value of what the funds owned reduced substantially over time, and there were a lot of fires to fight.
And did you thrive in that environment?
I spent most of my time probably petrified, but I learned a lot. And that was, we restructured a lot of debt. We tried to recover as much equity value as we possibly could. And that entailed, that was changing the asset plans. It was working with the lenders, working with joint venture partners, trying to find liquidity and capital, selling assets. So it was, it's hard to explain now, because in today's world, there are a lot of funds that are sitting on the sidelines just waiting for distressed assets to be thrown their way. But at the time, there was real, genuine distress in the market. And that's sort of where I learned, about countercyclical investing, which is you want to be the person with cash when everyone else is holding assets. And you want to be the person with assets when everyone else is holding cash. And so that's not so hard for people to understand. But what is difficult is that LPs, so the investors who put money into these funds, are a very intelligent but very pro-cyclical group. Meaning when real estate is doing well, they want to put more into real estate. And when real estate is not doing well, they want to take it out of real estate and do something else with it. And the hardest thing in the world is how do you make sure that you have the money when the asset prices are cheap? And do you have the conviction in the sustainability of your business to sell assets when everyone has the cash and their pockets are loaded and they're ready to write you a big check?
So you mentioned there petrified. Why were you petrified? Is that petrified of losing your job, having been over here in the UK, even though you're from the US? Or is it just petrified in terms of, just the sheer quantum of work and hours and business plans and the mountain of the task at hand?
I felt the weight of responsibility as a fiduciary really for the first time. In other words, my job, I wasn't managing my own money. My job was to manage other people's money in a very turbulent environment full of uncertainty. I was petrified that I would make further mistakes. I was petrified that no matter how hard I worked, I would still just be pushing water uphill. And as soon as my grip loosened, the water would just come rushing downhill again. I was petrified of losing my job. There was a point in time where there were 70 people maybe in Goldman Sachs real estate investing at let's say that was the peak. And when I left with others to go join Blackstone, we were down to 12.
Wow.
So it was a very, very rough time. I mean, the firm was wonderful to us. I think that, the people that they wanted to keep in their seats, to work through the assets. It was, despite the difficult environment, it was still a really great place to work. But when you are, you spend every day moving from crisis to crisis, it took a toll.
Why do you think you were one of the 12 that stayed?
I've been asked that question before, and I'd say that I sort of had a joke that made the rounds, which was at Goldman, the most important discussions about your career happen when you're not in the room. At Tishman Speyer, I got to a place with the assets where I knew the assets inside and out. I knew my tenants, I knew my leases, and we'll come on to this later when we talk about Blackstone. I had met tenants, I knew what was important to them. I knew the real estate really well. And I think one of the reasons I was kept around was I knew the real estate really well.
You knew the people, you knew how it fit together, and losing you a lot of information would walk out of the door with you kind of being gone, I guess.
I was also, I think, in the right place at the right time in that I'm also a German national and spent a lot of time in Germany, and Whitehall had a very large exposure to Germany at the time. So I was on, every Monday morning, the 7 a.m. flight from Heathrow to Frankfurt, along with all my, competitors at Mesref. We all sat next to each other and commiserated and so forth. It was quite a time.
You touched on the move from Goldman to Blackstone. How did that come about, and why did you decide to move?
I think after a time, at least sitting in 2012, it became very clear that the future of real estate as an independent business within Goldman was not really assured. Goldman hadn't been raising any funds, and raising funds is the lifeblood of a asset management business, a real estate asset management business. A very close friend and colleague had moved from Goldman over to Blackstone, three of them actually, who are all in very senior leadership positions at Blackstone today. And we're all friends. We were all in the trenches together at Goldman for years. And I saw what they were doing, which was Blackstone at the time was taking advantage of the retreat of the large investment banks, basically Mesref, Goldman, and Lehman, but others as well, and basically filling in the void as let's say the intelligent, liquidity, nimble solution provider for people who needed to sell real estate. And I saw what they were doing, and I started asking a few questions, and eventually they said, "Well, look, we'd love you to join us and join our real estate team in Europe." So I thought, the time, sort of reached the 5-year stage at Goldman, and thought, this is an amazing place, but the opportunity is elsewhere.
And your role and remit was asset management, right?
Yes.
And in terms of the UK and the European structure at that particular time, what were the assets under management? How were you structured? What were you investing in, managing?
Sure. Well, Blackstone Europe at the time was a fraction of the size of what it is today. It had mostly invested funds 1 and 2, European funds 1 and 2, and had begun to invest fund 3, but had periods of time where it wasn't investing at all. It had just undergone a leadership transition with Chad Pike moving over to start TAC Ops and Ken Kaplan moving from New York to run Europe. And let's say the dust had cleared, or I'd say the dust had settled a little bit on the battlefield with the global financial crisis, but no one had given the all clear signal yet. It was still a very, very difficult time to put capital to work. But it was a business build. And the AUM was in the low billions at the time. Now it's in, clearly, the high double-digit billions. It only had really one product, which was the European Opportunity Fund. Today it has all of the SMAs, the Opportunity Funds, the debt funds as well. So it was small, but it was about creating something. And creating something with people that I knew very well and that I'd worked with. The business, which was at that moment was being led by John Gray and John Schreiber, was intrepid, willing to take calculated risks, and had a very, very clear investment thesis around buy, fix, and sell real estate. And that's sort of what I had done before. I hadn't bought it, but I did know how to fix it, and I did know how to sell it.
Property is a people business, hence the name People Property Place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. And in terms of the sectors and the geographies, were you buying direct real estate as well as platform builds at this particular time? So
Blackstone in the US had done EOP, Equity Office Properties, and Hilton. And the story around platforms, and this is the beginning of the last decade, the story around platforms was really, in real estate, was not very well understood and just getting started. We had at the time at Blackstone no platforms in Europe. and I was asked to build Logicore. And Farhad Karim and I were the first employees and directors of Logicore. And we had a very difficult time getting people to join because no one really understood. No one really
As in join the idea of a European logistics platform.
Yes. And Ken Kaplan said something very smart to me. He said, go over to Chicago, where Blackstone had just started a logistics company called Incor, from a number of assets that were sold from that were acquired from distressed owners. He said, go there and just immerse yourself and learn what they do. And I will summarize what he said, but he said, bring it over and let's try to duplicate it. And we built a logistics company from scratch, literally from scratch, like everything you could possibly imagine. It was a startup, and we had to get budget approval. I remember, difficult budget approval to hire a PA. And I remember I couldn't get budget approval to design the logo, so I designed the first logo myself, which is the logo for 4 years until Mo Barzagar changed it. The CEO at the time changed it to something else. It was bootstrap because there was no, where was the money going to come from to do this? And what was the value? Because at the time, the perceived operating wisdom in the industry was the private equity investor buys the real estate and then hands over to an operating partner to go execute a business plan. And the operating partner is motivated because they have a little sliver of equity and some fees and a promote. And we had to basically bring all of this in-house and create a fully functional, all singing, all dancing real estate company that was capable of doing everything. My plea to my colleagues in acquisitions, which was heated, I was very happy about, was I want this company to be as vanilla as possible, meaning no complicated developments, no entitlement risks, no strange assets, double story logistics. I want everything to be as much as possible a blank canvas so that if Tesco moves out, I can get DHL to move in. Make the real estate as simple and vanilla as possible. Let's focus on locations that are where you can point to me on the map that there are 5 different tenants that are looking for space in those areas, and then we can scale it. Right, the more heterogeneous, the more like complicated and idiosyncratic the real estate is, the harder it will be to build a business around it. And for the first, I'd say 3 years of Logicore, by that time we had probably gotten to about 50 assets. I knew every lease. I had met most of the tenants. We had a weekly leasing committee. And we had just hired our first CEO, Mo Barzagar, who's out of Prologis, who's a terrific developer and manager and leader. And then that's kind of like that's how we got going. It was, I wouldn't say brick by brick, but it was not obvious. And I remember we had our first Amazon warehouse in 2012. And Amazon was doing something that everyone thought was completely insane, which was they had built a warehouse that was not designed to sell books. And in 2012, it's okay, Amazon would come over from the US, probably lose a lot of money in the UK selling books, but whatever. And Amazon had built this warehouse to do things other than sell books. And it was perceived as one of the riskiest things. What's going to happen if they're going to call you in 18 months and say, it's not going to work out. We're going back to selling books. We need to get rid of the space. And my view on it was, okay, if that happens, there are 5 tenants with active searches of 250,000 feet in that area in the Midlands. We'll be fine. So things that appear super obvious to everyone now were not obvious at the time. And that was I think looking back, you can say, oh, it's so exciting. You were there at the beginning. But no one knew I don't, not even those of us who were involved in getting the business set up knew how fast it would go and how far it would go and what the institutional demand would be for logistics. Because up until that moment in time, logistics was a sort of like a I'd say dirty, but sort of like a grubby, like why would you buy a Tesco logistics center at 8% when you can buy a Tesco supermarket at 5%? And Blackstone's answer was, well, that's exactly the point. Is it the same credit, but we can get that credit at a 300 basis point spread. So let's pile in money. And it wasn't obvious to everyone. It was obvious to John Gray, who was a complete visionary about it, but it was not obvious to the market. And to John's credit and to Ken's credit and everyone in the leadership team at Blackstone, they were huge believers in the potential of the business. And once it got going and once it became a sort of like a story that we could tell to investors to explain, we're not just sort of buying real estate and financially engineering it, we're actually getting involved in the leasing and the operations and the strategic thinking. We're trying to understand, how do our big tenants like the DHLs and the FedExes and the Sainsbury's and the Waitroses of the world, how do they think about the world? What kind of real estate do they want in the future? Then it got going, and now it's like I see Logicore people. They have lots of different people doing lots of different deals all over the market. I think it's a terrific business, and it's probably the thing I'm most proud of at Blackstone. Yeah, for sure. I mean, I did a lot of great stuff.
You did a lot of other platforms as well.
Yes.
Talk to me about those.
So Blackstone bought Multi, which was a shopping center developer that was previously owned by Morgan Stanley Mesref, and went back to a consortium of 14 different banks. And Blackstone basically acquired the debt one by one from each of these banks and tried to, or successfully took over Multi, but at a very, very low cost, and then proceeded to fold a number of its other retail assets into the Multi universe. And created Multi as, let's call it like a retail version of the Blackstone's retail platform in Europe. And at its peak, it had multiple billions of assets under management, 180 different retail assets between factory outlets, mainline shopping centers, triple net leases to DIY stores in Germany. It was a fairly heterogeneous collection of assets, and it was operating in 14 different countries, and with several hundred people. So, and I think we had done the math. It was like sort of out of nowhere became the 5th largest retail platform in Europe, and Blackstone's timing was very fortuitous because it began to assemble its ownership in Multi in sort of 2013, 2014, just as the world was starting to recover from the Great Recession. So this platform was the benefit of building stores for Zara and H&M and so forth. And as consumer spending rose and rents rose, it became a really, really interesting place to deploy capital.
So talk to me about your kind of skill set then, because you got into real estate initially through your grandfather who had this asset that you had to kind of work out how and where you're going to drive value to pay for your schooling. And then almost by accident kind of found yourself in the real estate private equity game and have kind of slowly, and whether it is fortuitous or calculatedly, like moved across financial engineering and banking through to development to asset management, coming over to the UK and turning a business around through great recessions to platform building and being very well capitalized and really pioneering and innovating in the space. Had you had any time to stop and breathe and take stock? And where would you say at this stage in your career your real skill set and value lied?
It was really in working the assets. And I was doing what I loved. I think, were there frustrating moments? Of course, because the path forward is never really clear. And you are making decisions that impact, especially in a platform, people's lives and livelihoods. You are impacting returns to the fund. But the support system was incredible. You were never really alone in making a decision. There was always someone's door you could knock on and say, "Hey, this just happened. Do you have a few minutes? Can you help me? Can we talk about this?" But it was around that moment I had to give a presentation to a group of Blackstone investors on Logicore. It was really the first time, and I had someone from the investor relations team who was wonderful, helped me put the slides together in the Blackstone format. It was the first time I had done that. It was actually the first time in my life that I had to get up in front of a group of people and explain what I was doing with their money. And you think that's sort of strange, but very few people in real estate private equity, especially at the more junior end, will spend actual time with investors. And the other strange thing is very few people in real estate private equity spend time with tenants. We tend to focus on our deals. So I had to get up on a stage and do this presentation for 5 minutes on Logicore to explain why we were doing this crazy thing. Everyone else was buying office buildings, why we were buying warehouses. And after it was over, Gary Summers, who was the head of investor relations at the time of Blackstone, said, "You are helping us with our next fundraise." And then I met two of the most talented people in capital markets I've ever met. Lama Kanaza, who now runs equity capital markets for Blackstone in Europe, and Kathleen McCarthy, who is the global co-head of Blackstone, and said, you need to help them with the fundraise. If they ask you to meet an investor, go meet the investor. And Kathleen came over to Europe. She had just given birth to her second daughter, and she brought her daughter with her for a few weeks. And Kathleen was responsible at the time for getting Blackstone Fund Europe 4 off the ground. And Blackstone hadn't raised a European fund in a long time. Its last fundraise, Fund 3, was pre-Great Recession, pre-GFC, and Fund 4 was all about distress. And I got involved, not just doing the asset management, but also supporting this fundraising initiative. And that kind of brought me back to my first job at Merrill Lynch, where I was working on the fundraise of Colony's continuation fund back in the 90s. And it sort of got me thinking about, well, I spent all this time on real estate, but I haven't spent much time on the investors. And that was, I think, sort of like the last piece for me that was missing. And the whole value chain was understanding, why do investors do what they do? How do they distinguish between funds? How do we make a fund more attractive? How do we make it work both for the manager and the investor? And I'd say Logicore was like the capstone experience at Blackstone. A close second was working very, very closely on the marketing of Fund 4.
So what was it specifically that they identified in you that they were like, we've got to have you on that fundraising team? Is it because clearly unbelievably right, very technical from a numeric perspective, clearly very curious, very hardworking, and also just knew all the data points across the whole value chain, right down to the granular aspect? What was it specifically about you that they wanted you on the team?
Well, I'm not a salesman, and I've never really. I don't think of myself as someone who's assertive or trying to get someone to buy something that they otherwise wouldn't buy. And I don't think I'm much of a storyteller either. I tend to sort of ramble and talk about what's interesting to me. I think most people are like that, but I am two things in one. I have very many negative qualities, but maybe two positive qualities. I am very macro, in the sense that, I read a lot and I see, what is the impact of this or that on the real estate business or what we're doing overall. And I also am very micro as well. Like I will say, this tenant's lease is up in 6 months. What are we going to do? And why are we doing something now about it? So I will get into the details, but I'm also very, I also try to see the bigger picture at all points in time. And I think if you're in a discussion with an investor from a credibility perspective, assuming you're genuine and authentic and not making it up as you go along, the conversation touches both points. because it's about why are we investing in this asset class in this fund in particular, and why in these deals. And I think, from their perspective, they thought I could support that. Maybe also the other answer I could give is at the time we were a very, very small team. The entire real estate department fit on one side of the fifth floor of 40 Berkeley Square. It's now, I think, 5 or 6 times the size. So I think the answer that I'd probably give you is I don't know if there were that many other candidates to help them.
You left Blackstone after 5.5 years or so, and in some of the literature I read, effectively retired from there. So clearly you'd made a couple of quid on your journey and your way through. What was the thinking? What was the rationale at that particular stage?
So, if I think I was 40 at the time, and my third son had just entered school. And I thought, if I don't do something now, it's never going to happen. And I'm a very, very risk averse person, which is very strange for someone who's in real estate equity. I am constantly thinking about risk. Go back to what I said about being terrified every day about the distressed investments at Goldman Sachs that I had to manage. So I thought, if I do something, I need a backer. And when I started Realty, we were 25% owned by Starwood. I had met Jeff Dishner and Barry Sternlicht, and they had both said, "Well, if you put something together, we'll invest in you." And then I had also done a lot of work with McKinsey. When I was at Blackstone, I was a McKinsey client in that when we built or when we restructured one of the platforms, I knew that McKinsey did a lot of work for the private equity side of Blackstone. I thought, well, they're helping restructure all these companies, but we also have companies that need restructuring. So I met some really talented people at McKinsey, and I thought, okay, well, I'm going to call them and tell them that I'm leaving and I'm going to start this company. And when I talked to McKinsey, they said, well, we're actually getting really into real estate as well. Would you consider doing something with us? So I think, by the time 2017 had come around, Realty had, no assets and no people other than me, but it had this investment promise from Starwood, and it had this business promise. Of course, couldn't take the promise to the bank, but it had a promise from McKinsey that we would work together. And I had thought, okay, well, I've got these 2 names. They haven't really given me any money yet, but the conversations are good enough. And I don't think it's, how could I possibly do better than Starwood? How could I possibly do better than McKinsey? This is enough. Let's give it a go.
And so what was the plan or the view? Because if I'm not mistaken, you touched on earlier, like the macro and the micro. You kind of very much take that philosophy into Realty as well. And in terms of real estate, you're kind of all sectors. In terms of geographies, you've got a global remit. You've got a prop tech arm that you actively invest in. It's so wide. And Realty on one arm, it's like the family office part, but then you've also got some institutional grade backers, but also corporate clients as well. How did you see the business and the evolution of the growth?
I wasn't trying to recreate Blackstone. I think that's what, when you leave Blackstone, a lot of people think your next job is to try to figure out how to recreate it. And there are people who have done that, rather like Tyler Henritze with Town Lane, or they create specialist operating partners like James Locke with Rotation. Although these were not examples at the time; these were much later than the time that I left Blackstone. What my idea was is I was looking to found a business that really had no constraints on what it invested in, and had no ambition for scale. In other words, to do one good deal would be much better than doing 5 mediocre deals. And it was a business that was built on conviction themes. Your listeners may have heard of conviction themes from Blackstone. And so that's how I'll describe it to the audience, which is there are ideas that we have where we think we have an edge on how to make money in real estate that is research-based and that has enormous downside protection. So I'll give you an example of that. In the UK today, it's a very gloomy place to be from a financial perspective because of the enormous strain on the public sector finances coming out of a decade of very, very low growth, some political shocks, beginning with Brexit, but reverberating even to today. But when we look at the UK, we see that the UK does three things enormously well. It does education well. People want to send their kids here. It does global financial services very well. People who have no nexus to the UK route financial tractions or through London or hire law firms based in London. And the UK also does research and life sciences very well. And there is an urgent need in the UK for the real estate to support this. There's a major shortage in student housing. The buildings that are, the quality of the building stock in the city of London, with the exception of few marquee buildings, it's actually rather poor. A lot of these things were put up in the 80s and 90s and are outdated in terms of electric capacity or amenities or so forth. And everything we do is the real estate answer to a broader question. So in the UK, where there are a lot of reasons to be very down about investing here, why does the money have to go here? It can stay in the US or stay in Asia or so forth. We see opportunity because there's a real estate answer to a larger question in the economy or a larger question in society. And all of our investment is thematic in that way. And the reason why I use the term conviction theme is because it's not just an idea that develops around a few pints or around a coffee table. It might start there, but it has to be ultimately very research based, where we say, okay, well, if this is the real estate answer, what are the costs? What are the risks? And because we do that in other countries as well. For example, Germany, we have an office in Hamburg. We have an office in the United States and do the same thing in the United States. But we are saying real estate is the answer to a question. And if we can participate in what we think is the right answer, a convincing answer, a profitable answer, then we will move our own capital there, and then we raise capital or work with like-minded investors to do the same.
How easy is it to kind of get locked into kind of groupthink? Because a lot of people think about themes and thematics in a similar sort of vein, and you can go down such a single track. How easy is it to distance yourself from that groupthink and be able to rise above the noise and maybe identify the next theme or the next view, especially as you've got such a broad remit?
We mark everything to market at least once every 90 days. So every the story, oh, we'll get a tenant next month, or financing costs will come down. Don't worry, everything's going to be fine, or the rents are going to go to the sky. Just hang on. We mark everything to market, and it doesn't matter what we paid for it, whether it was high or low. We think, what is it worth in the cold light of day now? So in other words, every story that we have told ourselves must be confronted regularly. But I need to look at what is the data? What is the data telling us? And then we also spend a lot of time in the market with tenants. I'd say probably one of the things that distinguishes us from a number of the other, we'll call ourselves like a micro organization. I don't want to say like a startup or entrepreneurial. I think it's maybe like overused these days, but we are a micro investor effectively. And we only have power if we partner with larger institutions that are like-minded about our themes. And I think what distinguishes us is that we know how, or I guess we could say we claim to know, but I think we know how occupiers think. And most of my job, I would say, is thinking in the eyes of the occupier. And it could be anything from small to big. For example, small, when we look at student housing, and we've gotten pretty big into student housing in the UK, and we're having we'd love to do more. I put myself in the shoes of a mother or father who are taking their child to university, and because they're ultimately paying for the room, and they want security. They want their kid to have comfortable amenities. They may be on a budget. They want, X minutes bike ride, Y minutes bus ride. They want to be their kid wants to be in the center of the action. How do our room sizes compare to the student housing asset across the street? Well, you have to share a bathroom. All those sort of little micro questions go through my mind as I also think about the macro point, which is this country is excellent at exporting education as a product and is reliant, effectively universities are reliant on it because of the limited funding they get from domestic students. And I have to think about both of those. If I focus, the question is, which one do you focus on? The answer is we focus on both. And we do this in everything, in things we do in retail. I have to think about, well, if I'm a brand, if I'm, H&M or Zara or Boots or M&S or anyone, and I'm looking at this city, where do I want my stores? What size stores are they going to be? What is the sales productivity of the store? What does that mean in terms of the rent I can afford? How does that compare to the current rents? I put myself in the mind of the tenant. In our marquee London office development, 75 London Wall, I just think, well, what is the, how many employees am I going to have here? What are the functions that they're going to be doing? What is the space I need per employee? How is that space divided between office space, conference space, gyms, amenities? And we have to put ourselves in the mind of the decision maker because they will choose our building, they'll choose some other building, who knows? And this is what is constantly occupying my time is I need to think like my customer.
And then you reverse engineer the real estate to fit that.
Yes, the question is what solution is the real estate providing? Is the real estate an answer to a question?
And so you see real estate as a broad allocation rather than a broad allocation and the ability to flick between various different sectors and geographies rather than just trying to sell the same thing over a 10-year period.
Yes, that's, we have this joke, which is, why don't we become a London office developer and then convince everyone to build London office buildings 10 out of 10 years? Well, that's probably not right. So would we have permanent capital in London office for a 10-year period? Yes, absolutely. Would we develop 10 out of 10 years? Definitely not. So part of my job is to think about where is, globally speaking, if we are unconstrained, where can I get the best risk return? Now, you might say the best risk return is a vineyard in Greece. Well, I don't really know anything about that. So I have to think, let's limit myself to what I can do, which is projects in gateway cities where that are densifying, where the gateway cities tend to grow faster than the surrounding economy. So if you hear that GDP in France grew 3%, you know that Paris grew 4%. So where are the bets already stacked in our favor? That's urban real estate.
And then how do you see the US versus the UK and Europe?
The US is a more liquid, transparent market, generally speaking. The UK is highly dependent on external capital, meaning I think the UK is the 7th largest economy in the world with the second largest stock market. The UK only works if the UK capital markets only work and property only works if foreign capital wants to come here. It has to want to cross a border. It has to want to go into a different regulatory environment. It has to want to operate in a different currency. And because of that, the UK is subject to cyclicality and shocks. The US tends to be a little bit more insular. And the US has natural population growth that the UK doesn't necessarily have. So the US has fast growing cities. The UK doesn't really have that unless they are involved, unless there's like a regeneration story going on with them. So the markets are very different. And obviously the markets in the US are much broader and deeper. But on the other hand, both are great places to invest capital for different reasons.
And you just have to pick the time and the place and the asset class and the deal at that particular time.
Yes.
You've got a barbell analogy when you look at a real estate deal. Can you tell us about that?
Sure. Well, our barbell is things that are super distressed, super cheap, where you can buy it at a yield that is an all-time high, meaning a price that's at an all-time low. And you have a plan for it, and the plan can be executed, and the plan is capitalized, and the plan has a time bar on it, where things are so distressed, like it was a beautiful asset in a piece of lousy wrapping paper, where if you can just get through the wrapping paper and throw it away, you have the gift is amazing. Or the joke would be like, you have to work hard to lose money on the deal. We love those. If we just have a different perspective, or we're willing to put liquidity into a place that is illiquid. And then on the other hand, so those are the things that are, you've had the great and the good of distressed investing on this podcast, and I couldn't possibly compete with some of the amazing stories that they have to tell. But when we can buy what no one else wants, and we know that we can almost sign our names in blood, that we can create an investment that will be a perfect investment for the pension fund and insurance company universe in 5 years' time. In other words, I want to buy something today that the insurance companies will want in 5 years, but don't know it yet. So that's at one end of the barbell. And the other end of the barbell is things that are high growth, where the market is underappreciating the amount of rent growth potential or yield shift that scaling up in that asset class means. And maybe for us, the most current example of that is, an asset class of the future is data centers, but something that's sort of happening now is student housing in the UK, where which has become highly institutional, previously very fragmented, and now is becoming more and more highly institutionalized. And everything in the middle,
you're not interested in.
We're kind of like, retail net leases at 5%, or logistics warehouses at 4.5%. We're not interested in that because we have nothing to say. We have no angle. We have nothing to add. There are plenty of other people who want to do that.
Yeah, you don't have the capacity or kind of need to look at it. You'll just be really focused on the quality rather than the quantity.
Exactly. And one thing I've learned about being small with a small team is we can only ultimately afford to spend time on the things that we can win.
What is something that you have previously held as being 100% true and is a core kind of belief that you now no longer believe to be true?
Well, look, I come from the asset allocation world, where the prevailing wisdom of, actually, let me take a step back. The capital markets are basically governed by 100 insurance companies, pension funds, sovereign wealth funds, financial institutions. There are about 100 of them. They don't know it, or they don't necessarily act in unison, but they make the world go round in real estate. In other words, if a Canadian pension fund wants to put an extra dollar into student housing, or a Middle East sovereign wealth fund wants to take a dollar out of real estate and put it towards infrastructure, they are the marginal buyers, or they allocate the marginal dollar of capital to the fund managers who then go out and buy things and make deals happen. And having started in this industry raising capital for real estate funds, I had always thought that the pendulum will shift, but eventually comes back to a place where the people who are allocating capital in these large institutions are basically making market shift without knowing it, will always have between 5 and 10% of their capital in real estate. Because of the diversification benefits or whatever. It's just and everything else is stocks, bonds, private equity, what have you, alternatives. I no longer think that that's true. Because real estate as an asset class has, in some respects, categorically failed to deliver the promised returns, or has delivered the returns, but with more volatility than people thought that they were taking on. And I no longer believe that real estate has an automatic right to be the 5% in somebody's portfolio. Because, for example, we have now alternatives like infrastructure, which is a longer term, more cash flowing investment, which is from an asset and liability perspective, asset liability matching needs of a pension fund for long-term assets. Alternatives have emerged to real estate. And even within real estate itself, there are now lots of alternatives. You can invest in a debt fund. You can invest in you have a choice between open and, open-ended or close-ended. There are continuation funds, but I no longer believe that real estate has an automatic right to its 5 to 10%. I feel like we need to fight for it. We need to argue for it. And the case has not been categorically convincing in the last few years.
Yeah, I was going to say the last few years, real estate has been, massive turnoff from the conversations that I've been having with capital allocators, because why would you take the risk when you're getting a risk-free rate held in bonds or cash? What's your take on your macro take on the market right now?
I am cautious about the future of. I'm cautious about the future of real estate as an investment, and one of the reasons, but not all real estate in all places. I feel like the problem that we have as an industry is we tend to underwrite rent growth automatically, as if we have an automatic right to take more money out of our tenants' pockets every year. And in some cases we do. That's just the market, that's supply and demand. But I feel like the market where it stands right now, if you think about the returns that real estate is generating relative to the risk that you're taking, and we should talk about what that risk is. It's financing risk, it's leasing risk, it's residual value risk. You have a building that's not environmentally friendly at some point in time. You're going to have to you or the next owner is going to have to spend quite a lot of money getting it up to scratch. And if you think about the returns and the risk, I think we are not yet back in a place where it makes sense to just pour money generally into real estate. And let me actually back that opinion up with some data. The real estate cyclical market peak, I think, was 2007, where in 2007, pre-financial crisis, where in 2007, you could buy government debt, the strongest credit, large credit in Europe is Germany, in terms of large scale issuance of government debt. Their government debt was trading, 10-year government debt was trading around 4.5%. You could also, at that time, buy a office building on the Maximilianstrasse, which is like the nicest street in Munich, prime office building with great tenants for 4.25%. So in other words, an investment that would give you no trouble and no risk whatsoever was 4.5%. But the riskier investment, the office building, maybe a higher return because over time the rents grow, sure. The riskier investment was yielding less. So in other words, the market was inverted. The asset that was going to give you more trouble was harder to buy. And with, hindsight being 2020, of course, that all unraveled. And then maybe you fast forward to, let's fast forward 10 years to 2017, where government debt is trading at zero. So you get no return whatsoever. And you could probably buy that same building for 5%. So the yield moved a little bit, but not by much. Now the market is telling you for the asset that you can make, if you want no trouble and no risk, you get a 0. But if you are willing to take a risk, you get a 5. So I went from a spread of minus 0.25%. So in other words, I was paying somebody else to take on more risk. That's crazy. To a spread of 5%, where for not, an office building on Maximilianstrasse is not a risky investment in the whole scheme of European real estate. It's probably as risk-free as it gets. So for the most prime real estate investment, relative to the most prime debt, the market is paying me an extra 5% to take that. So that was, I think, the best time to buy. Now we're in a place where the yields are, let's say, in the 4s and 5s, depending on what country you're in. And the yields of government bonds are in the 4s and 5s. And the yields on prime real estate are in the 5s and 6s. In other words, I'm going to get paid an extra 1.5% to take on the risk and reward of owning real estate relative to government debt. In my view, that is insufficient.
Notwithstanding the capital appreciation over time?
Notwithstanding the capital appreciation over time.
Because?
Because people look at the capital appreciation, but not the cost. In other words, for me to, if I wind the clock back 30 years and I think about what is the service charge on an office building or a block of flats or whatever it happens to be, I could have a service charge on an office building in Chicago or Dallas or something like that for $10 a square foot, provide security, cleaning, reception, insurance, whatever, repairs and maintenance, the lifts, cleaning the glass facade, whatever it is. That's about $25. So if I think about that, the cost that I need to incur as the landlord, I'll get reimbursed by the tenant, but they're not necessarily going to pay. That's their higher rent, right?
Yep.
A lot of the rent growth, in my view, has gone into cost. And a lot of the building may appreciate in value, but the replacement cost has also gone up. In other words,
net.
What it would cost me to, congratulations, John, you've owned an office building for 30 years, but I now have something that is 30 years out of date from a tech perspective. And whoever buys it and wants the prime tenant is going to have to invest. And they're not going to do that for free, right? That's going to come out of my value. So if I look at capital appreciation versus residual value, and I look at yields versus general yields across the market versus government debt, I don't think that the case for investing in real estate generally is as compelling as it's been in the past.
Do you think your definition of success has changed over time?
I think yes, and that's probably come with maturity. It's probably been less about financial gain and more about satisfaction. I've maybe perhaps learned the hard way, but I sort of work better when I'm challenging myself. And one of my downfalls is that, I am as hard on other people as I am on myself. And that is, the success for me. Success has become more holistic. It's about job satisfaction. It's about building the team. It's about spending time on things that I enjoy. And it's about, it's the excitement about where's the business going to go from here.
Talk to me about your non-exec career, because you sit on the boards of a lot of firms. Why did you do that?
I come from a big company big investor culture, and being on the board of a of a company allows me to be in a larger universe, where I'm going to see more transactions and have a broader perspective than I can just being in realty doing a few deals a year. And I think the being a board member versus working in the company is, you spend a few days there a month. You spend a lot of time with the non-execs who come from all walks of life, not just real estate, but also it could be from law, it could be from finance, it could be from the tenant side. So the quality of people that you interact with is tremendous. And I think being on the board, the boards that I've served on a number of boards since leaving Blackstone, has been terrific, because I feel like I still have something to contribute to the kind of the large permanent capital investor universe. I really, really enjoyed working there. But at the same time, I'm not necessarily constrained by it. And that's been a lot of fun. It's allowed me to, spend more time in retail. It's allowed me to spend more time in Germany. And it's been a great addition to what I've been doing.
Talk to me about prop tech and why you invest in prop tech, and also your take on AI adoption and where that fits into this world of real estate, private equity, and investment management.
Sure. So if you remember back to the barbell, we believe that technology has the ability to enact profound change on real estate, not just from a financial perspective, but also from an experience perspective. And that real estate in general, we have been slow adopters of technology. There are many times you go to a construction site and you see someone there with a clipboard that they have like the yellow form and the red form and the pink form and the blue form, and they're all going in different places. And we're asking ourselves the question, how can technology unlock innovation in real estate? Not technology for its own sake, but what are the uses of technology that can have a provable impact in real estate, either because they improve experience, they reduce risk, or they enhance returns. And our investment in prop tech is purely balance sheet. So we don't do it necessarily. We own a small percentage of Pi Labs, which is a large VC, and they're a terrific partner of ours. But all of the investments we have in prop tech are basically on balance sheet and our own capital. We work extensively with partners, but we don't manage any money for them, just our own, because we are taking tremendous risk in some of these ventures. But each one has something in common, which is that we think it is the unlock to a question that doesn't have a clear answer yet in real estate.
As we draw to a close, Jon, a question I ask everyone on the podcast is, if I gave you £500 million worth of capital, who are the people, what property, in which place would you look to allocate that capital?
So only in real estate?
Only in real estate.
Okay. Well, I'd have to say, first of all, Jon Lurie, who is a Green Street analyst, used to say that diversification is the only free lunch in finance. And that is a core belief of mine as well. I would split that 500 up probably 5 different ways. I would look at things that are high growth, like student housing in the UK. I would look at things that are on the other end of the barbell. I think Germany provides the most interesting distressed opportunities today. So I would look at high quality assets in very difficult, complicated capital structures that need to be unwound. I would invest in data centers, selectively in markets that have supply constraints and good rental growth. Probably prime office in London as well. And then finally, I would look at income producing. I would look at shopping centers that are income producing and regionally dominant. And I would split it. You can say, 1/5 across all of those sectors. They're not all going to work out the same, but would have conviction in each one of those.
John, I'm afraid I'm going to have to draw our conversation to a close there. I've got a stack of other questions for you, and I feel like I could talk to you all day. So, conversation for another time.
Sure.
But thank you so much for being so generous and sharing a little bit about your background, journey, views, opinions, and career trajectory, and shedding light on how you see the market, where the opportunity set is. I've certainly learnt an awful lot, and have every confidence that the people listening to this will do as well. So thank you, and I'm excited to see what you and your team at Realty go on to achieve.
Thank you very much for having me.
Hey, quick one from me. If you enjoyed this conversation, do me a favor and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.